What affects the price of gold? In this presentation, we'll be looking at interest rates, real interest rates, and how these both impact the price of gold. Interest rates refer to the interest payments that governments make on their bonds. And these interest rates change, and they can change in two ways. Either the central bank will intervene in the markets and raise or lower their baseline interest rate. And the baseline interest rate is used as a benchmark for commercial banks to price mortgages, and also they determine what interest rates you get when you deposit cash into an ISA or your bank account. So that the central banks can actually change these themselves through policy, but also market forces can do this for them, because as people buy and sell bonds, the price of these bonds will go up or down. And if bonds go up, it means interest payments go down on that bond. If bonds go down, then interest payments will go up. So the market can set interest rates through the markets. As discussed previously in the course, gold is very sensitive to the changes in interest rates, but this is slightly caveated because there's a mantra when you come to invest, and it's buy on rumour, sell on news. And what this means is that if the UK economy is performing very well and the market expects the Bank of England to raise rates by around 0.5%, they will start to reprice sterling in terms of gold anyway. So by the time that the Bank of England come out and actually announce a 0.5% raise in the interest rate, the market was already expecting that. It's already priced it in, and it's already looking for what's going to happen next. So on the announcement, you might not really see much of a revaluation. So that's why you should buy on rumour and sell on news. But as we've already discussed, that because bullion has no cash flow, the demand for gold is very dependent on how much the bonds are yielding. So if you lend money to your government and they're paying you very little interest, then why not hold gold? But if they're paying you a generous amount of interest, then you might decide to sell your gold and buy that bond and receive a higher return on it. So the higher the return on bonds, the less demand for gold. What is often overlooked is that this relationship is not as binary as what people think, because there's been many occasions in the past where gold and interest rates have moved together. And I've got a couple of examples here to show you. So the US entered the 1970s with treasury bonds yielding around 6 to 7%. Gold was at $35 per ounce. At the end of the decade, gold hit $850 per ounce, and the 10-year treasury bond was yielding 15%. So the bonds doubled, the bond yield doubled, and gold price went up to $850 per ounce. More recently, in 2004, 2006, this was in the middle of a 10-year bull market in gold, and the Federal Reserve's base rate increased from 1% to 5.25% during those years. And gold rose again 84.6% between 2004 and 2006. And some further evidence that the gold price can track increases in the interest rates. The federal funds rate, which is the US base rate, was at 0.12% in November 2015, and this was iterately increased until April 2019, where it was at a peak of 2.4%. Gold actually rose 9.5% in that period. So this shows you that the interest rates going up is not a guarantee that gold prices will go up. They can both co-move, and there is a reason for this. And this is that, historically speaking, nominal rates and gold have gone up at the same time when investors realised that interest rates are being increased because of higher levels of inflation in the economy rather than actual economic growth. And this is where we can see the real value in understanding the difference between nominal interest rates and real interest rates, because real interest rates can fall whilst nominal rates are rising, and this completely explains why gold prices can actually go up when interest rates are rising, because if the Bank of England is raising its base rate, but the pace of inflation or the rate of inflation is increasing faster than the bank is raising its interest rate, then you'll have a situation where the nominal rate is going up because the bank is raising rates, but the real interest rate is actually going down because inflation is going up at a higher speed than the bank is raising interest rates. And this situation is very bullish for gold.